Hey, what's up? What's going on? Just wanted to come on quickly and talk about what happened on the close yesterday in GameStop. There was a lot of kind of confusion out there, and I have both praise and criticism for the sort of average viewer out there. First of all, the praise. When people don't know what's going on, you see more and more of people saying, "Oh, this is a scam. They're trying to screw us, manipulation, blah blah blah," and I think that's good to be always skeptical and always thinking that somebody is out there to try to get you, because guess what? They are. That's the nature of the market. Someone is trying to take your money at all times. And although it may not be the manipulation in the exact way you think it is, people are certainly trying to take your money away. But you can't blame them. That's what you're trying to do too, is take their money away. That's the nature of the system. So, getting mad at a hedge fund or a market maker for trying to take your money, they don't get mad at you for trying to take theirs, right? That's just the way this system works. So yesterday we saw on the close in GameStop, the volume all of a sudden jumped. And not only that, right before the close, we had this big rally. Let's take a quick look at the chart, and you can see what I'm talking about here. All right, so here's yesterday's chart in GameStop, and we can see the big rally at the end of the day. If we go here, yeah, boom. And you can also see down here this volume spike. Now, we had traded around 3-point-something million shares by the end of the day, which is pretty good, actually, for GameStop as far as shares. We've had a couple days lately where we only got around like 1 million shares. Now, back in January, February, we had days where it was over 100 million shares trading, but things have kind of noticeably quieted down in GameStop. Now, remember, when you've got a company whose share price is $150, then the amount of money changing hands for 1 million shares is a lot larger than a company trading, $12. So keep that in mind as well when you compare, say, AMC to GME. AMC has a quarter the amount of share price as GME. So 4 times the amount of shares trading is the same dollar amount as GME's normal trading, if you wanted to compare them on a dollar for dollar basis. But let's talk about the spike at the end of the day. And to do that, I have to back up a second. Now, a couple weeks ago, it was announced that GameStop was going to be added to the S&P Mid-Cap 400. Now, what this is it's an index of companies, and the fact that GameStop has had such a big rally has put it in the company of, to use probably the improper term, to put it in the same group as a bunch of bigger companies. So the mid-cap, now I'm not exactly sure exactly what the requirements are to be a mid-cap company, but GameStop has ended up fulfilling those requirements, and thus it was announced a week or so ago that it would be added to the mid-cap index as of Wednesday to this morning. That means that by formula, the day before, which would be yesterday afternoon, at the closing price, a bunch of shares needed to be bought, right? So this is publicized. Now, I know the trading of shares has gotten more murky over the years. It used to be that New York Stock Exchange traded stocks, otherwise known as listed stocks, were basically traded by one guy who is like the specialist, and more accurately, one company would run the book on a specific New York Stock Exchange stock. As things have gotten more fragmented, it's not the same now. There are, the dark pools, there's electronic trading, and there's really not that much difference these days between a NASDAQ and a New York Stock Exchange stock. However, in the case of something being added to an index, it still is the specialist in New York's responsibility to deliver those shares. So the specialist in New York knew that he would have to deliver several million shares of GME on the close yesterday. So how do you handle that? Well, with the stock trending lower, it's hard because you've got to buy a bunch of shares. Now, the number of shares he needed to deliver is 3 or 4 times the average daily volume lately. So he's having to either take a big risk and just sell a bunch of shares and end up really short himself and try to buy them back at a later date, or he needs to buy shares ahead of time so that he can deliver them to the people buying them to bring these into the indices. So now the specialist, as much as he wants to make money and everything, he is most concerned just about fulfilling his obligation to deliver these shares and not get hurt too badly, right? So, they use various methods of estimating how many shares he's going to need to deliver at the end of the day. He can look at the weighting of GME in this index, and he can get a good idea of how many shares he needs to deliver at the end of the day. Now, there is a lot of misinformation out there about entering an index, and so you've got some people coming out and saying, oh, well, every time a stock goes into an index, it rallies, or every time a stock goes into an index, it sells off. So what you need to do is you buy shares ahead of time, and then when it goes into the index, it's going to rally, and you can sell your shares out at that moment. Now, it stands to reason that things are not that simple, right? If every time a stock went into an index, it rallied ahead of time, and you could just make free money every time something entered an index, no one's going to just give you away free money. So what ends up happening is the specialist has a good idea of how many shares he's going to need to deliver. He can play it a number of ways. He can buy all the shares ahead of time, and then when he sells them to the customer at the end of the day, then the transaction's over, he's flat, they've got their shares, and everything's cool. Or he could buy some of the shares ahead of time and end up being short after that trade at the end of the day and try to cover his short at some other moment. In addition to this, there's some volatility on the close because of the misinformation about, oh, well, the stock's definitely going to rally, the stock's definitely going to sell off. There's people who are trying to take advantage of these ideas. So let's say, for example, I know that a bunch of Reddit people are going to buy the stock right before the close because they think that it's going to go up because of this index thing. Well, I might buy some shares myself too and try to sell them to the Reddit people at a higher price. All this kind of games goes on. But essentially the dynamic here is the specialist firm who runs GME in New York needed to deliver 10 million shares at the end of the day yesterday. And on the close, you saw that big volume spike when they did actually deliver the shares to the people that need to buy them for the index, the ETFs, and the people that need to buy them for the index. That's what that volume spike was yesterday. And the volatility we saw with the stock going way up and way down could be a number of things. It could be the specialist. The specialist would find out the exact number of shares sometime in the afternoon before the close, and he might have been off by a couple 100,000 or even a couple million shares and needed to buy those last million shares at the last second, or there's just rampant speculation right before the close, before this mid-cap thing happens. But when you saw that spike in volume and you saw all those shares trading at the end of the day, if you are a serious trader of GameStop, you should know ahead of time, oh, well, that's it entering the index because this has been widely publicized. Don't expect to be able to win on a playing field with trading professionals if you aren't keeping track of the news stories that are coming out in your stock. You should know your charts backwards and forwards. You should know what's happening in the stock. You should know when earnings is, what the earnings expectations are. You got to take this stuff seriously. And I would not use some guy on Reddit as your news source. There's tons of channels out there now that are they're just telling you what you want to hear, basically. They're coming on, they're saying, buy all these stocks, it's great, this is definitely going up, the squeeze is on, blah, blah, blah. They're just parroting what they heard on Reddit with no actual knowledge themselves or any insight whatsoever. They're just giving people what they want to hear. It's confirmation bias. And ultimately, having someone tell you what you want to hear is not going to aid you in making money. It's just... it might make you feel good for a minute, but this is not about feeling good. If you're serious about making money trading, you need to have a serious assessment of your position, and you need to start to understand your own behavior in different situations so that you can put it in check to successfully make money. That's my rant for the day. I think it's healthy that people think that there's manipulation going on and all this stuff. You should be afraid because people are here to take your money. And my hope for you is that you don't make it too easy for them. It shouldn't have been a shock that there was some volatility on the close yesterday. In a situation where you know something's going into an index, it might be best just to take your position off for that last couple of hours of the day and put it on the next day, because that's a volatile situation. There's no rule that says something's entering an index is definitely going up or it's definitely going down. There's different people trying to play this in different ways, and maybe someone overestimates one way or the other and the stock makes a move one way or the other, but it certainly is not as simple as, oh, it's going in an index, it's going to rally before the index. If just think of stuff rationally. If every time something went in an index, it went up, people would not be selling it right before it went in the index, right? Nobody's going to sell something if it's automatically going to be a loser for them. So these things that seem so obvious and common knowledge are usually turn out to be the opposite of what you're hearing or thinking on the street. In my mind, I will go to the gas station and I'll hear somebody at the gas station say, "Oh, did you hear gold's going up next month?" And think about it rationally. If everybody in the world knew gold was going up next month, then who would sell gold to you? Nobody would, right? It would have already gone up. So try to elevate your thinking a little bit. What's up, Edward? Nice to see you. Hey, Tom. How's everybody going? How's everybody doing? There were some questions yesterday about on the close at the end of the stream about how the VIX prices are determined. Now, the VIX prices are determined based on the SPX options. It's a strip of options, which means a group of options that are sampled. And the exact formula is not really disclosed and changes. It's kind of like your FICO score. You can kind of extrapolate what it is to a large extent, but the exact formula is not publicized. But it is a list of options. And if you do go to the SPX, which I'm pulling up right now, and look at options 30 days out, that's going to be very close to what you have for the VIX. Now, the last question that was asked by the guy yesterday was, how does the VIX price change? Well, that's going to be due to supply and demand for S&P options, right? If there's fear in the marketplace, the SPX works this way in general. Most fund managers are long the S&P 500. Either they're long the individual stocks or they're long the SPX, and they stay long it over vast periods of time. They want to collect the dividends in the stock, so they stay long it for long periods of time. However, if they get skittish about market conditions, instead of selling out their positions, what they do is they buy protection. So they'll come in and they'll buy put options in the SPX. So when there's fear out there and the market looks like it's downturning, people will come in and buy these put options in the SPX somewhere. You can see the volumes here. I have open interest listed here on the far right. And when people come in and buy the put options, the prices get raised, right? Because this is the way the market works. If somebody comes in and buys a bunch of stuff from you, you don't want to sell anymore at that price, so you raise the price, and the price keeps going up until there's an equilibrium reached between buyers and sellers. So right now, if we look, the 30 days out volatility is showing 18.63. Now, this number, 18.63, is some sort of average. If we pull, there's a skew. There's what's called a skew in the SPX, and what that means is that different strike prices have different volatility. So if we look at the money, right now the SPX is 43.67. So if we go to 43, let's see, so I'm sorry, 44.23. So if we go to 44.23, the closest strikes here, which is right here, you can see as the strike prices move lower, the volatilities are higher. So if you look at the probabilities here on the right side here, I'm sorry, if you look at this thing that says implied volatility, you see as the strike prices go down, it goes from 15, 16, 17, 18. It goes higher as prices go down. Now, this is because of the phenomenon that markets tend to crash down. If there's going to be a big violent move, it's not going to be a big violent move up. It's going to be a big violent move down in some sort of crash situation. So the skew to the downside, these out of the money puts being worth more than the out of the money calls, is in response to the fact that markets crash down as opposed to crashing up. Now, certainly things can spike upward, but there's more likely to be a crash down, and that's why you see the skew here. So this number here that says 18.61 is kind of an average because you can see each strike has a different volatility. However, that's going to correspond very closely to the VIX number here, 18.80 we see today versus 18.61, very close to each other. The other way you can think of the VIX is just kind of like the average volatility of the market. So you have some stocks that are high volatility stocks. You know, if you look at Tesla, you can see volatility 50. Now, that's not a super high volatility stock. 50 is not super high. I mean, GameStop, we look at 126 volatility, and this number is much higher than the average market. You know, the market average of this, the VIX here, I tend to think of it sort of as a market average 18 is a much lower volatility than some of these high-flying stocks. That means that the average market moves around less than these stocks do. You see like a 5% down day is a big day in the market, whereas a lot of these stocks will move 5% around in an hour. Do VXX and UVXY have more downy potential when the difference between M1 and M2 is more bigly? So VXX and UVXY are the opposite as far as skew to the SPX, because volatility tends to spike upward when the market goes down. The skew is to the upside. So out of the money calls are going to be higher volatility than out of the money puts in UVXY and VXX. And the difference between M1 and M2 is referring to the difference in VIX futures. And there's not really a correlation between, not too much of a correlation between the difference in these futures prices and a down move. Certainly the difference between the M1 and M2, if there's a bigger spread between those two, it's going to mean more contango, which in the long term is going to create drag that pulls the VIX products down. But that's the long term. In the short term, the difference between M1 and M2 is not really going to, it's not going to correlate with moves in the VIX. If we are in a backwardation situation where the front month is way higher than the second month, that tends to be when stuff is going nuts, and definitely would be kind of a warning. And it looks like this VIX Central wants it looks like they're forcing us to take ad block off for VIX Central, which is annoying, but I get it. Everybody's trying to make money. So here's VIX Central right now. We can see contango of 8.61%, which is a decent amount. That means that these products are going to decay by around 8% per month, which is a big amount. Let's take a look just at the VIX once more before we take off here. And we see the VIX staying firm. We talked about this yesterday, but staying firm in that 16 to 20 numbers here. And I'd expect that to continue for the time being. We still have these COVID worries, but you know, the funny thing about the COVID thing is that we can solve this situation as more people get vaccinated, and we've seen vaccination rates explode around the U.S. as more people have gotten sick from the virus. So hopefully as vaccine, inevitably, more people get vaccinated, COVID is going to disappear. So that's great news. It's bad news, unfortunately, that it took, people getting sick to finally convince people to get vaccinated. But, I know people have varying opinions on that. For me, I'm happy I got vaccinated because I haven't gotten COVID. So that I know of. All right, so GameStop, I'm still have a very aggressive short position on. Let's look at that real quick before I let you go. I am short 106 deltas, meaning that the position would make $100 for every dollar that GME goes down, or lose $100 for every dollar it goes up. I did make an aggressive move, and I bought some cheapo put spreads to add to the position. So I bought the 190 put spread, so pretty far out of the money with 16 days to go. Here I paid 32, 33, and 34 cents for this put spread. Now it could be worth $10, so it's paying $34 per spread to potentially make $1,000 per spread. Now it's kind of unlikely that could happen, but at the rate we're going, we've been going down like 5% per day. So there is a chance, and it doesn't actually have to get down there for this spread to make money. So we'll see what happens. Position's been going great. You can see it's been very profitable. And, I'm not going to toot my own horn because I lose money plenty of the time, but at this moment I happen to be making money. So that's cool. Thanks everybody for watching. I hope it explains a little bit about what happened yesterday in GameStop. Continue to be skeptical, but at the same time, understand that when you're watching stuff from people that are just talking out their, their ass, you're not going to get accurate information. And someone just telling you what you want to hear, that can be fun for like recreation, but when we're actually trading and trying to make money, you need actual accurate information as opposed to just whatever someone heard on Reddit yesterday. With that in mind, I'll leave you. Thanks for watching, and we'll see you next time. Bye-bye now.